Okay, hey, this is DiverSK again, and we're doing part 2, options trading, AMC, good, bad, or ugly. So if you haven't watched part 1, then you should do that. You should watch the intro. We're going to get into some details in this one that are far beyond, but you need the introduction and you need to understand why we're doing this. So part 2 is going to be on risk, on rolling, on price selection and how to identify exactly what price you want to sell the put at, and how to place the order in detail. I didn't go into real detail before on the order placement, and for me, I think for new beginners this is absolutely critical. Okay, one primary question is if you have a platform to trade options with, because at the end of the day, you have to experiment, you have to trade something. You have to decide you're going to do it, and then you have to start trading. So you need a platform, you need options level 2 to do cash secured puts and covered calls. So that's the beginning. So I'm only asking you if you have a platform. I'm going to be using E-Trade, Power E-Trade. It's a good platform. It's, simple. It's not hard to do. And I want to make it very, very clear. Everything I do is very simple and basic. I use spreadsheets. I use simple charting methods. I use Elliott wave theory. But everything I keep very simple. I've been doing that way for 20 years. So I'm not one of these gurus who come out with all kinds of fancy software, all kinds of really cool stuff. And, I'm simply an old guy. I trade successfully for 20 straight years in the options market, for 40 years in the stock market. So what I do, I keep very simple. And that's, what I'm going to present to you. And I hope you can enjoy that. So as I was saying in part 1, there are 3 strategies. And I'm going to give you the acronyms this time. It's at the money, in the money, or out of the money. That are the 3 acronyms, are the trading strategies, and they call them ATM, ITM, and OTM. And this is what you're talking about when you are trading calls or puts. And this is related to where the price is in relationship to the strike price. The underlying is the stock. Where is the stock price in relationship to the strike price of the option? Okay, and another thing I have to do before I can go on to how we're going to pick the price on AMC is I think it's important that you understand how because this is my strategy, how I pick a stock. So I'm going to pull up a spreadsheet that I use to analyze a company. I found AMC when I was doing this normal procedure of filtering stocks and doing that method. And so I found AMC before I found Reddit and all of the drama over the whole stock situation and GME and all this kind of stuff. So there's a history behind that. And so I'm just simply going to go quickly through my spreadsheet about how I look for a stock. Okay, you guys, I'm going to do this really quickly because this is a whole another video if anybody's interested, but I'm going to show you quickly how I looked for stocks like AMC. This is a very old spreadsheet, which I have a new one now, but this is back at the time of January when I found AMC. So fundamentally, I'm looking at the 10Qs or quarterly reports, and I do a stock screener. And that stock screener is based on book price, which I try to find book price less than 2, and I compare it to the book price for the S&P 500. I look at the price per sales, and I'm looking at 0.7 when it's at market lows and 2.4 at market highs. And get me, this stuff is very complex. This comes from 40 years experience. So I'm only going to go quickly here so you have a general idea of how I got to where I'm at. I look at how much cash they have because that's very important. I look at the cash flow burn per quarter in millions. I eliminate goodwill out of the financial statement And so if you have no clue how to read a financial statement, I'm still going to be able to show you how you can do puts, but at some point you want to learn this stuff. Okay, then I look at how much debt they have, less than 10% current assets. I look at current ratio, which is the current assets over current debt or current liabilities. I look at the PE trailing, PE forward, revenue growth, shares per millions, float, revenue quarter, earnings per share per quarter, revenues forecast in millions, and short percent of the float. And there it is, short percent of the float. This is how I found GME. I was doing GME a long time ago, back in 2019, and I saw this 138% short of float. Plus, I found this cash, $1.6 billion in cash that GME had. They weren't going to go bankrupt anytime soon, so I thought, this number is going to blow that stock wild high. This was in 2019. Unlucky, I bought 2,200 shares of it and sold it in the coronavirus period, before anybody else ever heard of it, before I ever heard of Reddit or any of that kind of stuff. So just so you get a sense of how I find a stock. I found AMC because it had been, of course, through the coronavirus, it's beaten down to practically nothing. So also, it had a short percent at the time. I think I discovered it. I don't remember when I did this, but the short percent at that time, I think, was like 45 or 60%. So this stock became very interesting to me because, one, it's under $10, so that means it fits my risk strategy. So, this is the story behind how the stock was found. So I'm going to close that. I'm going to go to this one because I changed this design, in the last year. And now I have, basically I set it up vertically so I could put many stocks on the same spreadsheet. So, these are the kind of things that you need to look at to get comfortable with the company. So I'm going to only throw one thing out there that's the most important if you're an options trader, or even a stock trader for that matter. Option trading it's probably more important. And that is cash burn rate. And I have this set to the period remaining before cash is required. Okay, so AMC is 3.4, so that means it can go 3 to 4 quarters, probably longer because I set this up to be very conservative off the 10Q. Okay, so when you're looking for a stock, I'm usually looking for much more than that, but AMC has other characteristics that I really like. And of course, the community is the most important. But for example, here's Future Fuels. I did a little study on that. I actually own a couple hundred shares of it. It's not much. It's a very obscure stock, but it has cash to last 40 quarters. So, it's not an exciting stock, but I make a little money off it on options trading. And but this is just to give you a general idea of how you approach finding a stock and deciding whether it's worthwhile to play for the long term, because my strategy is based on building a position in one stock or a group of stocks and selling options against those stocks for a long period of time, as long as the options market is trading well in those stocks. So that's one of my strategies. And for this video, I'm going to discuss the strategy on out of the money or OTM put selling. Okay, so that's a strategy. I'm going to do it in 2 videos, I think. It'll be out of the money, and the next one, or part 3, will be in the money and at the money puts. Okay, but today I'm going to do out of the money puts. And why? The reason why is because if you're trading options, ideally as an options seller, you don't want to own any stock. Okay, so I own a lot of AMC because I like the stock, and other stocks I own also, but in general, I want to sell puts, I want to collect premium, and I don't want the risk of having the stock. And so the first thing I'm going to do is show the strategy that makes the most sense for a put seller. Okay, and this is going to be, in a sense, similar to what you would hear David Jaffe and those experts on put selling, but he sells naked puts. So I want to make this very clear right off the bat. I don't do anything naked, at least not. I got my clothes on, so I don't do any naked puts, and I don't do any naked calls. Everything is covered calls and cash secured puts. And again, while I have the opportunity, there's no financial advice. This is only for education. Okay, so the next point is discussing the yield, because one of the hardest parts is where are you going to find the strike price? Because a new beginner, he has no clue what price do I sell at if it's an out of the money put and I don't want to get hit with with an assignment or anything like that. So I'm going to pull up a spreadsheet. So this is what I use to trade with, and this is kind of like how I build a strategy and all that. And I don't have time to go through this whole thing, but I want you to see a simple method of finding out what the yield is, because the first thing you need to do is know how much money you're going to make. So people are swing trading or scalping and things like that. They're not paying a lot of attention to that. But if you're going to be trading long term and you want to make money all the time consistently, you need to pay attention to how you put your money to work and how much yield you get. So when I say yield, that's a term that I use for how much money you make when your money is working for you on an annual basis. So I want to make 51% yield, which means that if I put it in a bank account, my return would be 51% or 50% per year. That's what my minimum I want. Actually, I trade in a sense that I want to make 100% on my money. So if I invest $50,000, I want to make $50,000 a year on income. Okay, so here's a spreadsheet that I use, and it's based on here's the symbol, the price. So for an example, I set up an example for AMC. If the price is $36 and I sell a 36 put, that's exactly at the money, okay, with a trade date of 22 October, with an expiration date 1 week later, 29th of October, and if I close it on the 29th, that's 7 days, okay? That's a 1 week. That's a weekly. Primarily, I do weeklies. Here's my strategy for like next week and stuff like that. There's weeklies and whatever. But I'm just saying, you have 7 days and you close it in 7 days. You have a contract 1, contract 100. That's 100 shares. You sold it at a price of 36. So where did the price come from? The 36, I just made it up in my head. Why? Because it's exactly 1% of the strike. Okay, so that's what you're looking for. 1% of the strike price minimum. Okay, we want a lot more than that, but we can take that for a minimum because we're looking for 50% annual yield. Okay, the cost for me, it maybe varies for some people. Maybe it's $1, maybe it's 10 cents. I don't know what Robinhood charges or anybody else, but E-Trade charges me 51 cents, and then there's a penny that has to go to the exchange. All right, so that's the cost. 52 cents for me to trade this one contract, which is 100 shares of AMC at a strike price of 36. If I get 36 cents for the contract, my income is $35.48, which when you look at the spreadsheet, that calculation, blah, 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 365 divided by H3. H3, number of days, 7. Okay? In simple terms, if you don't know anything about spreadsheets or anything like that, or you're not good at math, it doesn't make any difference. In simple terms, if you sell a weekly at the penny price of the dollar price, $36, 36 pennies. That's 1%, and that means you're making 50% money yield on your money every year. Now, compared to a bank where you get 0.2%, you know, there's not very many people who wouldn't be happy with 51% on their money. And if you start at 20 years old and you start investing $1,000 and you start making 50% on your money, you got $1,500 to do the compound interest calculation, you're going to be a millionaire by the time you're 40. So this is how it works. Okay. So that's the fundamental method of defining the initial price you're interested in. Why do we do that first? We're doing that first because by the time you do the stock research and you've done the stock research and you picked a stock, by the time you do the technical analysis, you want to know that first you can get an options price that makes sense. Okay, because options pricing varies on all the different stocks. Sometimes it's good, sometimes it's bad, and this is what I've been saying on all my Twitter tweets, that AMC is the best money-making options underlying stock that I've ever worked with in 20 years. So I love it, and GME would have been even better had I not sold that. But AMC is awesome. Okay, so now we have to go and find that the strike price that we're interested in that's going to get us that 10% yield. And then once we do that, we can look for some technical analysis and see if that makes sense. So this is my strategy again, and I can use this time to tell you that you can make money buying calls, you can make money doing spreads. There's a million different strategies in options trading, including in selling options and everything else. But I just do it my way, which is very simple. And for beginners, I think the simpler it is, the better. The safer you are, and I will definitely be getting into how to manage risk, because that's the most important thing for a beginner. Well, that's the most important thing for people who have a lot of experience also. Okay, so we're going to go back to, now we can go to the options chain. Okay, now here we are back in E-Trade. If you didn't watch part 1, we're showing some examples on E-Trade. And this is the options chain. It's best for me to do it live so you can see exactly how things work and how orders are made and stuff like that. So again, we're looking, like I was saying, here I have an open order at 36. So that was a put I sold last week. When you want to try to pick a price, and here's a good example, actually. Here's a 36. You know, to make 50% yield, I needed 36 cents. But the bid is at 168. So I think I sold that one for 101 or something like it, 110 or 130, I think it was. I sold it for 130. So I didn't get the best point. And you know, here's something to show. You can actually click on that. You get a chart. And look, guess what? Looks just like, you know, a stock chart. So I sold it in here somewhere when it was doing this shit. You know, and so when you look at options charts, they're, you know, as a seller, you're selling theta, which is decay, which means the price of the premium or the price of the option continues to go down in your favor over time. So obviously, you know, even if the price of the stock is moving up, it's still, like here, it still is just decaying as time goes on. Okay. So that's a whole nother video. But at any rate, so we want to find, in general, you want to find, and here I sold a very close at the money, or it's not in the money, but this is what you call a at the money strike price. So we're on out of the money strike price. So first thing we want to do is we're looking at AMC. We go down here and try to find the matching price. We got a 21 cents. Nope, 31.30. There you go. $31 strike price, 30 cents bid. That means you got minimum 50% yield per year if you sell this strike. Okay, that's good money. whether you believe it or not. That's, on a weekly. This is October 29th. I'm doing this video on a Sunday. It's October 24th. But based on October 22nd's Friday's closing prices, this bid was 30 cents for a 31 strike. So then you have to say, would I be able to be safe to sell an out-of-the-money put at $31? Is there what is the chance or the risk that the stock will go to $31? So how do you decide that? And I'm only going to give you the methods, and then you would have to go and learn each one of these methods. So you have to go to the chart, and what do you have to do? You have to do some technical analysis on whether you're safe at 31. So we go to the chart, and this is AMC. So you can say, where have we been trading at? I normally look back 1 to 2 months and say, are we safe here? Okay, so if we go back to, let's say, even August 4th, we can go back quite a ways, but basically we're looking at lows here. So if we have a low here at 35.96, our closing price, well, that doesn't make sense. Wait, I'm looking at the wrong one. So we have a low of 29.81, okay? So in theory, the 30 could be reasonably safe, all right? And so if I was going to try to pick a price, I would go to the lowest point technically on all of the candlesticks and go below that. And theoretically, you should try to go 10% below that. But for the sake of this, I would say I'd be comfortable with a 30 for a weekly, because that means it would have to drop $6 more dollars and 60 cents in the next week before you would have to worry about rolling, which I'll be talking about what you do if the options price goes against you. So we go back to options. Then you say, okay, I'm safe at 30 or 31. So you could take the 31, you make 30 cents, that's 50% yield. And 30 cents is $30 times, 100, 30 cents, $30. So is that enough money for you? Is that very exciting? Maybe that's not so exciting, but let me show you something. Let's go back to this, and I'll say go here. This is options that I've closed in the last, period, and I've had this set for June or whatever, but I'm, August, whatever. Now, here's how I record it. I'm recording all of this stuff: trade date, expiration, closed, income, when I sold it, theta, gamma, and stuff. And you really have to do this. You need to set up a spreadsheet or something where you can track all this stuff, because otherwise you won't learn what's working for you. Okay? Look at these yields, 865%. Here, you have to look at the income. So June was a very good month, here, but sometimes AMC, 17 bucks I made. Here, AMC, 145, 86, 69, 156. These are weeklies. The 7th of June, 8th. These are puts, okay? These are calls. I have the light green is a call and the dark green is a put. Okay, so look at this. This is income channel. $328 on a 55. I sold a 145 strike price call. The price of the stock was at 55. I got $11.55 per share for that strike. And so, but I bought it back because, and I'll explain that in a little while, how you buy them back. But at the end of the day, I made $328. And look at the days it was open. I sold it with 39 days expiration, but I closed it in 1 day. So that yield is monstrous. So you will get the idea that you sometimes make huge money, other times you make small money, but the key is that you're blasting them out weekly. If it's 20 bucks, 30 bucks, 50 bucks, you know, it just adds up. And when you're a young guy and you pop out 50, 60, 70 bucks a week, you know, even if you're only trading one contract and you start, then you build to 2 contracts, 3 contracts. And when you're good at it and you're like me, I never lose money. There is no losses on here. You know, it really pays you well. Okay, I want to talk a little bit about getting a feel for the options chain. So I'm going to go through the options chain on E-Trade, but you should get comfortable with whatever platform you're working, and you need to just see how the options chains work. You see these color areas? So this means that here's the call column. This section here is the call. Here's the strike price, and here is the put column. Okay, so when you, and I can simply click these arrows and I can put it on, you know, now it's only on calls. All right, so now you're looking at calls, or I can flip the arrow back and then I flip it this way and now I have only puts. Okay, and this shaded area, let's leave it on just puts, let's put it on both. Sorry. The shaded area means at the money. Right here, now you're out of the money and you're in the money. So it's split. So here is the price right in between 36 and 37, 36.60. And so this is considered in the money and this is considered out of the money on a call. On a put, this is considered in the money and this is considered out of the money. So anything lower than 36.60 is out of the money. In essence, the strike price is picked. 36 is out of the money, but it's basically what we call at the money. All right. So, and I want to make sure if any experienced people are watching this, I have 20 years of doing the exact same thing, and I'm not any good at talking about condors and the acronyms and all the bullshit people want to throw out there because they're so good. You know, I don't know any of that. I simply make money. I only know how to make money at this. So I may say something wrong. You have to be careful. I may use the wrong acronym or whatever, but I'm basically telling you what I know, and I don't know a whole lot. I only know how to make money at this. So, you know, I'm sure I say some things wrong. So bear with me on that. So anyway, this purple shaded area is in the money for a put. All right. So you got to get really comfortable with understanding how that works. We're on, these are all the expiration dates. October, November, 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 each week. These are all weeklies, and then boom, what happens? What happened here? December, January. Okay, the market makers are not doing weeklies way out there. Why? Because there's no demand for them. All right, so they're doing weeklies in the short term and then monthlies in the longer term. But as you approach December, towards the end of December, they'll start doing weeklies in the January, as long as the options trading is good. So at some point you got weeklies all the way along. So you need to just play around with the options change. Do it on Yahoo Options. You can just go, you know, just click on all the buttons and figure out what's going on there. You have the bid, the ask, the last price, and what I was explaining before, delta. And I'm going to give you just a very fast explanation of what these are. And then later on, if I see that there's a lot of interest in the way I trade and the way that I explain things, I will go into detail. Otherwise, I'm not going to bother with it because there's 1,000 videos on how the gamma or how the Greeks work. And I'm not an expert at it. I have some tricks and I have some things that I've done that probably has never been seen before, but you know, this is a whole complex series of videos. But delta is fundamentally the probability that price will hit in 1 week. So you have a 42% chance the probability is 42% that it's going to hit 36. All right, and you got to really understand that delta, all of these numbers out here are changing every 15 seconds or whatever during the day, because every time the price moves, this changes. It's all integral calculus, if you want to call it. That's why they call it a derivative. These are derivatives on a curve, and they're mathematical formulas that are calculated based on strike price or underlying price. And so they change constantly. You know, but you need to, at some point, get a feel for it. And I'm going to show you by the end of this video, or by the end of the next video, how you can trade and not just be very much worried about this stuff. So this is just the delta, and theta is the decay. And there's the number that's the most interesting to the option seller. You're selling theta, they call it. It's the derivative that calculates how much that premium is going to decline, this $1.68, assuming that the price stays around 36. That's how much the decline in this premium will be every day. So when you're a seller, here's what you tell yourself. I get to put $16 per day in my guaranteed pocket at any time, because tomorrow, if I want to buy it back, I'm going to buy it back $16 cheaper. If I wait 2 days, I'm going to buy it back $32 cheaper. Okay, you understand that? So this is telling you how many days you think you might have to wait before you can buy this thing back. All right. Then you have the volume, you have the open interest. Open interest is interesting because when you have a lot of open interest, that means a lot of people are interested in this price. Okay? Gamma is only the rate of change, and vega is the volatility. Don't forget about those numbers. When you're a seller, you don't give a shit about that. Okay? So it's that simple. You need to understand implied volatility only in the sense as a beginner. You want to understand it long term, but as a beginner, you only need to know when it's above 100%, we like it. When it's below 100%, not so exciting. Okay, and now I want to show something, the most important thing to me, which if you were following me on Twitter, you would for sure hear all about what I say in regards to velocity. Okay, so over here, I want to show there's the volume. At that point, it was 46.32 million. Okay, when this is trading, when the stock market is open, this is live. Okay, so when I'm sitting watching the options chain, I'm watching that number. This number is the most important number to me, because all I sit there and do is watch this go 2, 3, 4, 5. Every time that clicks over another point, that's 10,000 shares, right? If it's in the millions. Some stocks will be in the thousands, and then it's not the same. But when this is a million, volume is millions, every time it ticks over, it's 10,000. So I'm counting as I watch it. So I turn it on and I go, it's only trading about, this is only ticking over about every 5 seconds. Boring, right? You want this number clicking over 50,000 per second. That's ideal. Okay, but when it gets to be 10,000 per second, when this is clicking 2, 3, 4, 5, then you're saying, now we got interesting, because you come back down here, look at that premium, and boom, that's going 168, 178, 179, 182, you know, these numbers are moving. When it's clicking over at every 10 seconds, that number is just sitting there. Boring, okay? When you catch this thing cranking over 50,000 shares per second, that number is going to go up so fast and so high, and then you click the sell button. You sell that option at extremely high volatility, and the decay will be so fast you'll be amazed. And that's where I was showing you that I'm making $800 in one day, or $500 in one day on one trade. Because, this is a fairly boring price at a 36 put. And this also applies on the call side, especially if the price is going up. And let me be clear about this. And you should really watch this several times, because this is the key. right? When the price is moving up really fast, your call premium is going to go up really fast. And also the put premium, it's not going to be so nice, but it will still go up because volatility is going up, right? So everything's going up. The call premium is going to go through the roof, and the put premium will also even accelerate faster than it would on a quiet day. Okay. Anyway, back to the timing and velocity. So the timing, velocity is only going to last for how long? Half a day or 1 hour or whatever. It's always going to be higher on the open. It's always going to be higher on the close. So these are the kind of the times when you want to buy or sell premium, or however you're trading, or buy to close, or when the velocity is less and calm, that's when you want to close out your premium. So let me explain how that is done. First, let's talk about the velocity. So one important thing, and this is where you would want to take notes if you're a beginner. When you sell options, when you sell a put, the put premium, this right here, this if you're at the strike, the put premium, let's go back to where we were. This is the far out of the money. This 30-cent put premium, when the price is going up on the stock, for instance, the 36.60 price is going to 40. This premium is going to go to 1 cent, 2 cents, or whatever. Okay? So the idea is to close out the option on green days, a put. Right? It's opposite if you're selling a covered call. Of course, if you selling a covered call, you get maximum premium on a maximum green day and high velocity, and then you want to buy that call back on a red day. But we're talking about puts here. So when you sell a put and the price goes up, 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 the premium on the put will go down, 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 and there you want to buy it back. Okay, so we're going to talk about how you open the orders in detail and how you close the orders, because I don't think I did that very well in the first video. So that'll be key. But that's something you must get in your head, and you must get used to it, because that's part of the risk strategy. You want to get rid of these options as fast as you can and keep your profit while you can. And why is that? Can you imagine on AMC, have you seen that? If you're an AMC trader, that means that you've seen that on a dime, this stock turns. And when it turns hard. If you're on a high velocity day, it'll run from 36 to 48 in one day, right? And if you're caught in a covered call, you would be in big trouble there. You would lose all your option. Or let's say you sold a 40 put when the price is 48 and it starts falling like crazy. Well, that put option price, that put premium price is going to go up, 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 up. Now you may not be able to close it at a profit by the time of expiration. So the key is on MOAS stocks, I don't care if it's AMC or another one, you want to get in and out as reasonably as you can while you're making money. So that's the point. Always try to make your profits and keep them when you can. And the other ideal thing is that if you have good technical ability, you can see where a stock might turn. So that means you could possibly sell an option twice in 1 week and make double the money if you can catch the turn correctly. So that's the reason why you do that. And think about it this way. On red days, you sell put options. On green days, you buy them. You buy the ones you sold back. Okay, so that's fundamental. That's notes to take. Okay, so I think it's important while I have the options chain up here to talk about risk. So we have, always risk. There's, the stock can go against you. It can go bankrupt. It can do all kinds of things. So what are your risks on AMC? If you sell this 31 strike put for 1 week out at 30 cents. So what's the risk? The risk is the stock price goes down, 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 down. This premium goes. Let's look at it this way. I can almost guess what it'll do. I've got long years of experience. So now stock price drops to 36. This goes to 40. Stock price drops to 35. This goes to 50. Now you're down 20 cents. Not really, though, are you? Because you got the 30 cents or the $30 in your pocket the moment you sold it. All right, so you're already up 30 bucks. However, on the option price, you're now more at risk. As it gets closer, what if it goes past 31, you might get assigned. And if you're an OTM put seller, you don't want the stock. All right, we have another video I'm going to talk about when you want the stock, because it's a whole different strategy. But when you don't want the stock, you'll do anything to avoid getting assigned, and that on Friday that somebody sticks you with 100 shares of stock. Okay, so as you're going, and there's only two ways to deal with the stock going against you. So now the price is going down, 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 and when it hits 31, this is going to be $1.50, more or $1, maybe $2. So this price is going to go up, and that is because of this delta. It's no longer a delta 10, it's going to be a delta 50. All right, so this is why you need to somewhat understand delta. So anyway, you get to the 30 cents, and now this is the risk. Now you're going to lose money, possibly. So what are your options? And this is the beauty of selling options. When you buy options, to be honest, I don't really know exactly how well you can roll out a bought option. You can, but probably not as good as you can when you sell them, because you have theta decay working on your side. So now I'm at 30, and let's say this drops to 31, right? And it goes to 150 or so. I'm just going to show you a trick. It's difficult because the actual options chain is still at 36, but we're going to pretend that it's at 31. All right, and for the absolute most bizarre example, I can show you still how you can do that, even though it's still trading at 36. So let's assume we have to buy this option back at 150, let's say. Let's just take a guess. 150, all right? Oh, wait a minute, look at those muscles. JP would be jealous over that. Anyway, if you had to buy this option back at 150, okay? Now, all you have to do is roll it. So what does that mean? That means I have to pay 150 to buy my 31 option back. Now it's closed. I bought it back for 150 bucks. And now I'm down $120 because I got 30. 150 minus 30 is 120. So I'm down 120 bucks. What do? Let's close that. Let's go out here December. Boom. And let's look at the 30. Fucking hell. I mean, look at that. Now, you would sell that 31 for $340. So, I'm sorry, you just made another $240. Well, now you're stuck in it till December 21st. But get this. This is the key. This is the key. I'm just laughing because it's just too good. I can't help but just tell you how good this is. So now let's go to the chart, and I'll show you what happens. Look at that. This is what theta decay does to you. All right? I can tell you by the time that this gets to, when you go week by week, it just keeps going this way. Because that's the decay. So even if the stock really, like here, look, it runs like crazy, the premium does go up, and but quickly it falls. And when this is falling, that means that the price is going up. Okay, if the price continues to go down, this is the second part of the risk. All right. But at any rate, you can get out of that situation on AMC this week. If you got into trouble on this week, you can simply roll it out. You don't have to go out that far. You can go out this far. Let's look at them one by one. Okay. Why is it not rolling? Anyway, let's try something else. Let's go. Okay. So we go to November. You could still do the 30 at a profit, 183. Because we decided that we would probably have to pay 150 to get it back. So, and I can tell you this from experience, you would normally, on a $5 down move, we went from 36 to 31. On a $5 down move, you're going to need to go out 4 weeks minimum, okay, to stay in the money. All right, but that's all you need to do. And even better yet, this is where you really define reducing risk. Even better yet, let's say you're getting uncomfortable with this 31 price and you think maybe it's going to go to 29. Bump out here to December. Okay, now we go to 29. And now you can get 250 for the 29. So you're still making $100, and you drop the put price by 2. Now, let's say over the next few weeks it goes to 29. You're like, shit. But because of theta decay, the 29 you will be able to also probably buy back at about 150, and you bump it out another week. You can do this over and over and over again. But guess what? I've been doing this for 20 years, and I'm a good enough technical. When you study charts, and you study technical analysis and chart patterns, you will not have to do this very often. It's rare. You sometimes get caught in a shit trade and you made a mistake, you're drinking too much or whatever, and you made a mistake. So then you have to roll it out. And that's, how you do it. It's really easy. And so I hope that explains it, how you do the roll, because that's the whole risk strategy. The stock can only go against you. That's your main risk. If the stock price goes down on a put, your premium is going to go up. You will not be able to get out of it. And if you don't want to be assigned, then you're stuck. So how do you, the other two methods of mitigating that risk? One, you only buy stock, you only trade puts on stocks that you want to own anyway. Don't do it on shit stocks. Forget about all these Reddit guys and people who pump and dump and all this shit. Forget about those. You find stocks you like and they have good fundamentals. And then, or if you hear something on Twitter or Reddit and it's suiting you and you want to get involved in that excitement, which I do sometimes also, you must do some analysis on cash flow and book value and things like that, because if you get stuck in a piece of shit stock that's just trading on momentum or on a short squeeze, you're going to lose all your money. It's that simple. So, pay attention to the risk. The biggest risk that I faced over my 40 years of stock trading and 20 years of options trading is bankruptcy. So when you have a bankrupt company, forget about it. You're out. You're shit. I've lost 4 times big. And, when I say big, I got caught in the crash of 2001, and I lost a huge amount of money on a stock that went bankrupt because I got caught in the middle of the trade. At the time, it fell 20 points in 1 second. So, these kind of things can happen to you, and you're now trading in the S&P 500 and Dow Jones and NASDAQ peaks. I'm talking about a huge bull market run that will end at some point. And when you get caught in a trade on the end day, I was on it March 23rd in 2001, whatever it was, as the drop was mind-blowing. And the amount of money you lose when you're trading, a margin and all that shit is mind-blowing. So you must preserve your capital, and you must make sure that your risk is minimized. So anyway, if you trade good stocks, you're at less of a risk of running into a bankrupt company. Okay, so I think that covers rolling as best as I can cover it. You know, it's a fairly complex thing, and maybe I would do one complete video on just rolling, but you know, you should be able to get the general concept from that. And so there's a couple of other points that I didn't make before on charting. When you're doing technical analysis, there's another thing that's called max pain. Okay, on options trading, and believe it or not, I have to thank Travis Rodriguez, or whatever his name is on Twitter, because he turned me on to a website called maxpain.com. Okay, prior to that, I actually understood it, but never read anything about it. I simply, you know, doing everything my old-fashioned way with spreadsheets. I used to take open interest and volume, and I would analyze where the skew was. Okay, so when you talk about skew, you're looking at, for instance, here's 36 at 590, and here's a 37 at 585. So this is the at-the-money strike area, 36.37. The premium on the call and the premium on the put are almost the same. Okay, that means there's no skew. But let's say that on the 36, this was $3, and on the call, it was $6. That would be skew, and that would be telling you that the interest on the call side was much higher. So I would be looking over here at the open interest, and I would try to get a rough idea about where the market maker wants to pin the price, right? So market makers are neutral. They trade delta neutral. That means they don't want to care about the direction of the stock. So max pain is a calculation that's done based on interest and volume and price. And they try to tag where they're going to cause the options traders the most pain. Okay, so you go to maxpain.com and you look at the max pain. And for AMC, and we're talking about, now what's the day here? October. We're talking about October 22nd time frame while I'm making this video. This max pain area is 39, 40, 37, 38, 39, 40. Okay, so it's just moving around there week to week, and I pay very close attention to that because you can trade close to in the money and pay attention to max pain, and you might be able to get away with it. Okay, but this video is about OTM strategy, out of the money, far out of the money. We don't want to get assigned, blah blah blah. And so I will for sure make a detailed video on how to trade right next to that strike price where you get the maximum amount of premium. See, the closer you get, the higher the premium. When you go down to 30, we're at $3, and this is December. So let's go back to October 29th, which is next week. You know, we're talking the difference between $1.68 and 30 cents. Okay, that's $168 and that's 30 cents. So the closer you can trade to max pain, the more money you can make, but the higher the risk. So we have to discuss that. So what are your risks? The risks just narrowed down into fundamentals is one, bankruptcy. The biggest risk to a trader is bankruptcy. If AMC went bankrupt, you lose all your fucking money. Simple. Don't kid yourself. It could happen. I don't think it'll happen the next year or so, but if they don't get positive cash flow, they will go bankrupt. I'm a firm believer in AMC, and I'm a firm believer in Adam Aron, and I don't think that's going to happen. But I'm watching closely cash flow. Every quarter, 10Q, I want to see what the cash burn is. I'm an old guy, and this is what I've been saying since day one. AMC needs to go cash positive and bring in a bunch of old farts like me, and then you would see the squeeze like you never could imagine. So we need to get rid of the debt. We need to get this cash flow positive. And so debt and bankruptcy is your biggest fear as an investor in any company, because your stock is going to be worthless and you will not be able to get anything for it, and you can forget about ever trying to recover. Me, I'm very good at rolling. I'm very good at selling and buying and doing whatever I can to roll a stock, and sometimes it takes me 2 years, but I always work out 100% gains in the long run. So So I have no fear except for bankruptcy. Biggest risk management is to avoid bankruptcy. Okay. And your second biggest risk is being assigned on a stock when you don't want to be. So you need to know how to roll. And the beauty of option selling is the ability to push the problem down the road somewhere where the stock may go in your favor. Okay, I want to go back one more time, and this is kind of a review of part one where we do the actual trade, because this is very important. I think it's risky for new traders to make a mistake. So I'm going to go back and show you exactly how you place the trade. I'm actually going to try it on here. If I do it right here, let's say I want to sell this put at 36. Actually, I already did, but let's say let's go down here and do the actual one we were talking about. Let's say I want to sell this. I go 30. Here it pops up the screen. Okay. This is my IRA account. I don't have a lot of money in there. I don't do a lot of trading in this account. But here you see sell, expiration, strike, 31, bid, save order, preview. You want to make sure that you check this. Estimated amount you will receive, $31 excluding commission. Okay, so you got to really look at this. AMC, 36.60 is the price. After hours, call put, action, sell, 1. October 29, strike 31, put, 30. Ask is 32. Price, the limit price, I want 31 cents for it because it's the middle range. Okay, all of this stuff, and there's the description. Sell, 1, put, blah, 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 blah. Okay, so that's basically how that works. This was covered in the first video, so if you want all the details about how I got to this point, you have to go back and watch the first video, and you should have watched that anyway. So at any rate, at the time you want to do the sell open, and this example was on November 5th, strike 36, put at 325. So I'm going to go through this in detail. You know, you have, of course, the stock that you're trying to trade, the symbol. Here's the last price and the size. What is the size? Well, the size would normally be something you would see showing up on level 2. Bid time size, ask time size. That means if you know anything about level 2 trading, you have a series of asks and a series of buys, and you see all of them. All of the preceding and all of the at the top is you're seeing the current ask and current bid and current ask, and at the bottom you would see the waiting bids and the waiting asks. Okay, and sometimes, you know, if you're on a level 2 system with a window, maybe it's showing you the next 10 below bids and the next 10 higher asks. Okay, so that's what these are, and this is the quantity of stock currently at the top of the chain. All right, there's your strategy. You, of course, if you clicked on this, you would have 20 different strategies you can choose from. Well, we want to do a put. We want to sell open, 1 contract, expiration date. If you have a platform, you can click on I and it'll explain that to you. If you have a strike price, you click on I, it'll explain it to you. It's information about what that means. Type the put. Bid size, 325 times 12. That means somebody is bidding for 12 contracts. That don't mean that one person is bidding for 12 contracts. That means there are 12 contracts being bid. Could be 3 people, could be 1, could be 12 people bidding 1 each. Okay, so that you don't care about that. You care about the money. 325 ask is 365 by 9, and the very last trade was at 330. What does this tell you? I can probably get more than 325. You're not going to get 365. They won't execute it. I can tell you that right now. This is a pretty big spread. You might get 340. I would probably shoot for 340 there. Okay, but this just comes from experience. Initially, you don't care about this. You just buy it on. You sell it on the bid. Sell it on the bid so you get executed. All right, this is pennies. You know, these dollars don't make any difference to you. You know, at the end of the day. So, you know, initially you're going to want to sell on the bid. When you get better at it, sell somewhere in between. Maybe once in a while when you think it's going to move up, you sell on the ask and just wait. Whatever. Okay, limit price. Of course, you can click on this and you get limit or market. Do we want to pay market price? If you put an order in for a market price, you might get filled at $3.05 because you have no way of telling what market price they think you'll accept. So don't ever sell for a market price. You put the limit and you put the price you want. There's what I would do, $3.45, somewhere in between there. All right. Good for the day, good for 60 days, good till expiration, good till date. These are all your choices within this window. All or none. Obviously, this is going to be that if you're selling one contract, there is no all or none. But if you are selling 5 contracts, that means you want all or none. You want all 5 executions at once. You don't want to be given, like one contract and maybe you miss the other 4 because the price is moving too fast. All right, so that you can decide then whether you're willing to one. But when you sell 5 contracts and you want to for sure sell 5 contracts, you click all or none. Okay, then you got the commission, 50 cents. The reason that there's 2 cents missing between the $3.45 and the estimated proceeds. This 2 cents is the fee for the exchange. It's called the exchange fee. So when you go in to understand, I have to pay about 1.5 cents per contract in exchange fees. I pay 50 cents to E-Trade and 1.5 cents. So the round off number is 344.48. Okay. Normally, if you start a new contract and you don't have any history or any quantity of trades, then you're going to pay 60 cents or maybe even as high $1 or whatever. Okay. So then you would just click preview order, as I said before, and it's going to give you the kind of the summary of this, and then you put place order if you're happy with it, and you're done. Okay, so that's the very details of how you place an order. Okay, and finally for this video, I'm just going to give you some tips that helped me when I started, or not when I started, but actually I learned everything by myself with no help. So fundamentally, you're never going to trade options if you don't jump in the game. You really are not going to understand how this all works until you do one. You have to do one in order to get it. Okay, so I'm going to go back here to the options chain. My feeling is, for myself, if I was a brand new beginner based on my experience and history, I would want to start with $1,000 and I would take a cheap price. And actually, this is another risk strategy that I use. I bought into AMC at $4.50, $6, and $7. Okay, I bought it at $4.50. I watched it run to 20 something, and then it fell back to 14, and I was like, wow, what the hell is that? That was before I knew about Reddit and any of these other news articles. Then I started reading news articles and started seeing what was going on and hearing about Reddit and Wall Street bets. So, but I bought the stock because it was cheap. It went from $2 to $4.50. I studied it. I like, wow, I like that. I'll take it. I'll take 200 shares of that, and then I bought a few thousand more shares when it fell from 20 back to 5.50. And then I studied it, and I decided to make a go of it. Partly because of the community as well. But at any rate, if I had no experience in trading options, I would want to start a little bit safer. But and again, this is my strategy. My strategy is saying, I trade options on stocks that I find under $10. And why do I do that? Because my maximum risk, I can trade Microsoft. I'm fucking good at this. I could do Microsoft, I could do SPY, I could do QQQs, I could do all those. But I like to trade with very minimal risk. So one contract on a $10 stock is $1,000. So the maximum, when I start into building a position, I start with less than $1,000 on that position, and I start building it. I start to understand it. I start to learn the stock. I start to feel it. And trust me, your mojo, your gut feeling for a stock is very important. So after I understand the stock, I put more money into it. Okay, so I like to start with something like AMC. I'm like, boom, 450 bucks. All right, I bought 1,000 shares at 6, but 10,000 shares at 7. Okay, and then then boom, it goes to 14. Now I'm safe. Now I can start to really make some money in the options market because my risk is practically zero. Okay, so risk strategy. Trade small dollar amounts until you're really good at it. And you could be like me, I'm really good at it, and I still trade small dollar amounts. I trade stocks under 10 bucks because it's safer. All right, so I'm gonna pull one up here as a recommendation, and of course, it's a medical company, and therefore they are a little bit more volatile, let's say. Okay, so you're not going to get near the excitement out of a stock like this that as you would, AMC or anything like that. But here's a stock that for $300 you can start trading one contract. Okay, so if you went out, and here I do things like I traded a contract at $3. I sold a $3 put. Of course, this was back when the $3 put sold for 80 cents. So I'm holding an 80-cent $3 put. It's in the money right now. And if I take the assignment, I'm fine because I will flip it and then immediately sell the call. All right. So when you want to learn how to do this, you take stocks that you have to find a stock that you're happy with. And I'll tell you, I like ATOS because they have about 10 quarters of cash. They don't have any sales yet. They're developing a drug, for coronavirus nasal spray, blah, blah, blah. But, it's a reasonable stock, and you have to do your own research, find your own stocks, but, trade something in these ranges. Less than 10 bucks, then your risk is $1,000. So that's one risk strategy that I use. And I think that's an important one. Trade with what you're comfortable with. When AMC was $4.50, that was a great bargain. It's now higher risk. I still think it's at a bargain price when it's under 40, but you have more risk because there's no telling what's going to happen when the S&P 500 dumps 1,000 points. Maybe AMC goes up, but this is all risk management. You got to preserve. If you have $10,000 in your trading account, you better do everything to make sure you keep 8,000 of it minimum through all the crises. Otherwise, you won't be trading next year. So, this is key. Save your money. Okay, I think that covers this one. It's been pretty long and I'm getting very tired. So, anyway, and I apologize as usual. I have no screen presence and I'm not exciting or whatever, but I'm enjoying trying to teach what I can. I wouldn't normally be doing this. I make tons of money. I make plenty of money in the stock market, and I'm not interested in making any money on YouTube or anything else. And I appreciate catfoodcannon. He's doing the edits because I really just wouldn't be able to do it. And so I'm putting this out there because I wanted I wanted to be able to teach what I know, before I get so old I can't do anything anymore. So I'm just offering this because when you get older, you simply want to pass on what you know. So I hope that you can enjoy it. And the next video I will do is going to be on in the money and at the money puts. It'll probably be fairly quick because I covered the really bulk of the details, on this one. And if there's a lot of positive feedback, you can follow me at DiverSK on Twitter and, send tweets or whatever if you want more of this kind of training or whatever, so basics, I'm happy to do it. Right now it's a good distraction for me. So I hope you enjoy it and stay tuned for part 3. And for sure, if you have not watched catfoodcannon's prelude to these videos, I think it's awesome. The Kong battle, and let's try to solve this problem between options sellers and Reddit and Twitter and fighting over, options trading. I don't want to see that really happening. The community is fantastic. We need to be strong together. and I'm only showing one side of it, selling puts, but obviously buying calls and selling calls and all of those strategies can work. When you're talking about waiting 10 months now for a MOAS, some people are going to fall out. And there's no reason to fall out. You can make more money on this in trading options and holding the underlying than you can make. I can tell you, 20 years of trading, I made more money on this stock than anything else I've ever traded, ever. So, you know, just hang in there. Come and watch part 3. All right, all the best.